Good morning, everybody. Welcome to the Flow Show. We're getting through this busy week bit by bit, and fortunately there's been some good volatility, lots of moves around, so that's hopefully good for your trading. Morning, Mr. K-Man. How are you, sir?
Morning, Ryan. Welcome back, mate. Good morning, everybody.
Thank you, mate. Yeah, let's see what's going on, shall we? Another central bank up today after the one yesterday, so we'll go through the headlines.
Next time we'll be warned when you take a day off. It's probably been one of the busiest days, data and event-wise, for a while yesterday.
Yeah. Well, can't be there all the time, I'm afraid. And I was getting a free lunch out of it, so profits all round as far as I'm concerned.
Oh, can I get one too then?
Sorry?
Can I get one too then, a free lunch?
You can always have a free lunch, mate, when you're working at home. Well, right, let's get stuck into things. There was a story dropped yesterday that the Bank of Japan are potentially looking to exit their ultra easing next year, according to a Reuters piece. They say, though, it will need some favourable conditions to do so successfully. Bit of a blindly obvious statement there. However, the main piece from that story was that many of the BOJ members see the likely timing of an exit as around spring next year. So putting a little bit of a time frame on it, we were sort of there or thereabouts, Q1, Q2, as to when they might do something. But that sources piece maybe adding a bit of fuel to that fire on that front. Not that there was much reaction in dollar yen on that, a little bit of a wobble, but didn't last very long. Norges Bank, they kept rates at 4.25% as expected, though they still see the rate going up likely in December. They do add that whether additional rate hikes will be needed depends on economic developments. These guys are very clear on what they do with rates. They take forward guidance in all its glory there. There's never usually a surprise from those guys. S&P's Jordan says that they don't rule out future rate hikes either. We did get some CPI data from those guys today as well. CPI coming in at 1.7% as expected and previous. Their core number coming in a little bit hotter than expected and previously, up 1.5% versus 1.4% estimated and a prior 1.3%. But all measures still below their 2% target. Over at the good old ECB, there was a sources piece out yesterday. Nothing huge, but apparently they were talking about what they're going to do with deposits, government deposits, cash deposits at the bank, because they've got a lot of money parked up there. So they're going to discuss, whether they're going to keep remunerating those deposits there. They decided to postpone making a decision until next year, the usual ECB can kick, because they're concerned that lowering the maximum interest rate paid on those deposits could have unintended consequences. We know they've got a big tiering system going on there, and it's just one of the measures that they'll be looking at to adjust so they don't pay out too much just to have governments park their money up. ECB's not says that restrictive policies are likely needed for some time and that the current policy stance is a good cruising altitude. So one of the hawks over there happy with rates as they are at the moment. Coming over to a bit more of the data, and particularly yesterday, we got some big data, manufacturing data. PMI is coming in. Manufacturing PMI, the S&P global number matching the flash number at 50, so keeping that contractionary level there. But ISM, a different story altogether, falling further into contraction, 46.7. There was little tick up in the prices paid number, but that's still in contraction. Employment as well, going backwards a bit, going into contraction also. As you can see there, new orders not looking too hot either. So not too good on the manufacturing front, which is largely par for the course around the globe at the moment. The big services number is the one we'll need to watch because that's going to be the bigger impact of the two. I'm just looking to see if we got the expectations up there. Where are they? Is that today, the ISM, Kay?
No.
The services number, when's that? Is that tomorrow?
I only see durables and factory.
Oh, it's tomorrow. It's after the jobs number, the services. Yeah, services tomorrow. So that's going to be the bigger one to watch. We're expecting 53 versus 53.6. So that's going to give us a little bit of a secondary wind after the NFP stuff goes through. So we'll keep an eye on that one. Over in Jolts, as you can see there, can you see it there? I can't find it. There we go. A little bit up over expectations and last month, but still well below that 10 million mark. Not much to take home from those numbers. Kay, got any thoughts on the Bank of Japan stuff and anything from the ECB before we get stuck into Powell?
No, perhaps you missed it, but yesterday we had a stark warning by Kanda saying that speculation was the major reason for the move. And Suzuki also commented and a couple of others, but really when we went up in the high 151s and again, we are not 100% sure what they are actually looking at, but the yen is really weak against everything, especially against the dollar, of course. But yeah, we got that speculation word came into play yesterday, and that held the market back from taking dollar yen and yen crosses much higher yesterday. That's the main thing on those comments. For the rest, no, there was a bit to do about the government stimulus plan again, which is coming in a bit higher than prior expectations, and then bit of confusion what is to be taken up in the numbers or not. And I think actually the media is a little bit under the reality still, because there's they didn't take into account the full one-off tax cuts, in my opinion. So that's the other side of the coin. Now for the rest, I don't have much to say about the Bank of Japan. Comments on the ECB is regarding the remuneration on deposits is, I think, part of the package that we had the day before yesterday, or after the ECB came out saying that they will discuss plans and packages during the winter. And I reckon it's just somebody picked out one item of the whole thing and made an article about it yesterday. Fact is that people like Not and stuff the hawks are saying that we are in a good place. So that makes us all think, or makes me think at least, that the ECB is also, barring surprises, kind of done. That's my view, at least. And that's about it. Over on those US events and numbers. I know you still need to start talking about the FOMC, but it's been a package as well yesterday, and it's been like a triple, a triptych, as I call it, between the US Treasury, the ISM, and the FOMC. The reason why the dollar all of a sudden, the reason why the dollar post FOMC especially started to come off. So yeah, yesterday was not a great day for the dollar, and not for the dollar longs either, on that front. But I know you still have to talk about the FOMC, so I don't want to front run your paperwork.
No, I haven't got too much to say, because there isn't that much to say.
Well,
but
there is one thing to say, and and opinions are opinions, okay? But I find it the most unhawkish meeting in a good while. Yeah, Mark said that had a bit of a slip up a few meetings ago, but I think this one as a whole, there is more talk about stricter financial conditions. People are saying that they are in a good place as well. I do think it's going to really take a big surprise on the inflation front or so, or tomorrow another big bumper labor report to make them hike more. And I guess that that was filtering through in yesterday's meeting as well. Powell repeatedly spoke about those financial conditions, and yes, they are leaving the door open, and yes, the data are good. But he did talk a bit about the being more restrictive in the financial conditions. What makes me think that when we saw those U.S. Treasury plans coming out saying that they're going to do more bills and then bonds and notes, and then Powell later, it does make me think. And usually I'm not a conspiracy theorist, but that they aligned themselves a little bit to for yesterday to come out with about the same speech, and that really put the train or boat or whatever in motion, and then helped with the weaker ISM. So it's been a very weak day for the dollar yesterday, in my opinion.
Yeah. I mean, I only had the privilege of just reading back over the headlines of Powell, so I didn't hear it live or whatever. But he seemed to walk the same, give with one hand, take with the other stance, hawk dove scale, restrictive stances, putting downward pressure on the economy. But the question is, should we hike more? The next question, how long will we keep policy restrictive? And, rate cuts haven't come up in a discussion. We're close to the end of the cycle, blah, blah, blah. It's the same old thing. I think the last hike is now sort of wrapped up in the emergency break glass box rather than actually being a tool on the table. It's moving further away from actually happening. But as I mentioned, if we keep getting this string of good economic data on the rest of it, things might heat up again. But I wanted to ask you about the Treasury thing, because I saw the headlines that they've upped the refunding by 9 billion or something, and they've gone through what they're doing with the different pace of what they're doing in what bills, notes or whatever. They're going to increase 2 to 5 year notes by 3 billion per month, going to keep the bill auction sizes the same in November. Is this anything in that for us, or is the market just going to read it, suck it up, adjust to it and move on?
Yeah, no, the message, and that's what I've been saying before as well. The message is in the balance of what they are going to do. If they would have said, like, we are going to do more of those of the long end, then you would have seen the US 10s likely temporarily at least shoot through 5%. The US 30s keep 5%. But if you look at the effect that it had, and actually with some delay, we had a first little round, then it stabilized. But actually, if you see with some delay, then all of a sudden the longer end started to react, and a lot more than the short end, which is not yet a lot, but which is, for instance, putting some stuff back into inversion, which it wasn't anymore, and widening very small the inversion again between the 2 and 10s, for instance, and that is also a factor that really it's mechanical nearly or model driven or whatever, that puts a little bit of weight on the dollar. And to come back on Powell, just the last line, I do think that he really spoke more about the effects that higher yields are having on the economy, and that they now started to really note those kind of effects. So in that case, in that sense, that is where I'm saying is probably the most unhawkish meeting globally that we had since maybe not since they started to hike or so, but I mean, it's not a dovish meeting by any means. The higher for longer message is still there. The data are still what they are, and one ISM doesn't make a winter, right? Especially
Yeah.
not the manufacturing one, but it's just a thing where the market says like, hang on a bit. I mean, this is perhaps not the market to be blindly long dollars, blindly short bonds, and things like that. We have to reassess. And then you see the equity markets also responded um, pretty heavily, taking the S&P quite a bit higher as well. Well, and others. But you know, it's one of those things where the market says like, hang on, this is perhaps we need to manage our books a little bit here. Still, also made a good point, and I will show the 10-year yield as well. That CTAs probably would have to buy back some 10-year futures also when the yield went below 480. We hung around for a while. Now we're trading below. So all of that is like, as I'm saying, like it's all a bit of part of the package, right?
Yeah.
Where the market needs to reassess, and
Yeah.
then you add to that in FX that we are holding levels. And that's more on the technical side of things. You're holding levels. We tried the 105 or close to 105 in euro dollar yesterday again. We tried the 121, the figure on the cable. We tried to get up to those prior highs in the dollar yen, and we, you know, this, and we tried even the dollar Swiss, you know, around 91, the figure I've been talking about for a while. We've tried all of that, and it's again a failure, or we couldn't break. And then you that also adds to what the market is thinking about, like, hang on, you know, this is not a one-way street in the dollar, despite the data and weak data in Europe, for instance, if you make it by comparison. So that's really what happened yesterday.
Yeah, yeah, and it just shows you again, you know, how central banks, or particularly Powell, has been pretty good at sending a message. You know, last FOMC they were just attentive to the moves in yields and the tightening that it's causing, and now they've stepped it up a tiny bit to a bit more attentive, and that gets the market thinking about it. But yeah, I mean, it's as I said, you know, coming into this week, start this week, it's all about where we are coming in. Can we go anywhere new? Can we break the ranges? You know, come through all the data, all the central banks, everything going on, where are prices left? And for now, they're sitting in the range. You know, we've come through everything this week so far. We've had a test down near 105. We can't get through there. We can't get through 107. That's your ballpark. You know, where if you want to play around in the middle here against your levels, that's fine. But these are the edges you want to put a bit more faith into, have a bit more conviction trading if you get near them, if you get close to them. And, you know, as we say, trade between the goalposts and see what's what. I mean, dollar yen, the reason I went short the other day was I was just thinking perhaps there was a bit of too much month-end stuff going on in this. You know, I couldn't see the Fed being uber hawkish yesterday, and I just felt, you know, maybe this is a bit of a time to try and see if we can pick a top up here. I wasn't liking it when I got in at 151.40 and we were rocketing up to 70s, but you know, I thought, really, can we do more on the back of the FOMC and, you know, seeing what the data's like and that? And as Kay says, you know, the dollar took a little bit of a pasting, but here we are. You know, the level that I'm going to be talking about is 150. That's my marker for this downside move now. If this is just a bit of a fake break this week, then we head back under. If we hold it, then we keep the break well in play, and maybe then we take a look at the highs and get those 152s that a lot of people, and that prior high that we had up here back, you know, in 2022. You know, that keeps it in play if we can stay above this 150. But if it gets under, then we're probably going to go back in this box, and then we'll be watching, you know, 148s, 150s again for a while longer.
And if you want, I can show it later. Stay on there. But if you widen it up a little bit, do the 4 hours perhaps also. Oh, yeah.
Yeah.
But zoom in. If you take put a trend line, so to zoom out a little bit. Zoom out to be a little bit longer. Yeah, take that high around February. Take that high around February, March earlier.
Yeah, there. Oh,
No,
where am I
February,
going?
March.
There.
Yeah, and then you
Yeah.
draw a line over the next high. It should take you up to 152 as well.
Oh, somewhere up there.
Yeah, see what I mean?
Okay. Yeah.
And that's why I've also been saying that 152 should a little bit be of a hot level up there in the room as well. Yeah, you know what? This yen is a bit of a strange one to me. Yes, we are having all those stark warnings now because the speculation word is back there. But then if you look around on the crosses, yen is still not gaining back much against anything. I mean, the only outlier may be a bit of the Swiss, but that's because of the Swiss has been trading weaker as well. But yeah, I
Yeah.
mean, we are lower than the highs. But if you look at euro yen, we're still trading close to 160, you know. And if you take stuff like like the antipodians yen, though they don't give any signals of saying like we are done here, yeah.
Yeah, exactly. I mean, the euro just remains fairly bullish, all round. It keeps coming back from the
Yeah,
dips. You
yeah.
keep thinking, oh, this is it. It's made a top, and now it's going south again. But it's not. It's coming back everywhere. It's coming back on the crosses.
Not
Euro
really against
sterling.
not really against the antipodians because that was my month-end play.
Yeah,
Because euro got really bought against everything into month end, and that is going pretty okay because the antipodians are risk currencies as well, and they we had to give back some of those euro pairs, right, into the end of month. It was a bit too obvious that it was euro buying for rebalancing. We saw it during 3-4 consecutive sessions in the European session that euro just got bought versus everything.
yeah. I mean, Aussie dollar's looking pretty
Very,
healthy once again,
very
and
good.
yeah, it's it just seems like the commodity block, if you like, is going a little bit bid at the moment. But we're still not breaking back above the trend. I could stick a trend line across there, something like that, just a rough one. If you want to take it, oh no, I won't. I've got it all magnetized and whatever. Let's take that off. We've still got this sort of downtrend happening here. Keep making those fresh lows. It keeps the pressure on this whole real trend. So until we still don't start breaking some of these highs, and particularly up that 65, it's a range play.
Yeah, I know. Yeah, absolutely.
And
But reversals always start from the bottom.
yeah, exactly. But I want to see better price action than this. I want to start seeing some higher lows coming in now, because then you can put a bit more faith in that low. So we may have one here if we dip from here maybe to 63.5 and hold it, and then move up. Then you're starting to build something. But when it was looking constructive here. You got 3 decent lows, but then it breaks it, and that just washes it all out again. And we've spoken about this with the Kiwi. We had the similar pattern. Then we got the holds, the higher lows, then the hold above it, and then you get in some movement, but you're still not busting the upside. And then the trend comes right back in again and slaps you in the face. And here we are doing all the hard work again, having to get above this 59 area again. So it's, you have times, I mean, this is, 2 months or a month between August and September where you might have something to cling to if you're trying to catch that knife, and you get some rallies and it holds the support. But then when it breaks again, you've got to reset the clock and go back to go back to go, as they say in
in the
Monopoly.
Kiwi.
It's like snakes and ladders.
Yeah, the Kiwi has made some really decent recovery since that weaker jobs report that we had. Well, the day before yesterday, late night. was a bit weaker, that jobs report, and then all of a sudden, well, I mean, good for me because I got done on on a euro Kiwi. But I mean, for once I was lucky. I think I've been done on like 3 pips or so from the top, which is really a lucky one. I've covered it, by the way, this morning because just because of that jobs report. I'm a little bit more constructive on the Aussie versus the Kiwi on the back of that. But remember, we were talking about this 59 level in the Kiwi already 3 months ago.
Yeah.
And we have to talk about it again on the Kiwi dollar because we're trading back on it again. So still looks like a bit of a obliged stop along the tube line, right?
Yeah, exactly. And, you know, Aussie key, you can always judge it again, you know, what's moving Aussie dollar, Aussie dollar, Kiwi dollar. You know, when you look at Aussie Kiwi, you know, yeah, we're maintaining this uptrend, but we're, again, struggling up at these levels. I've got put out the balance of my short from the other day at 40, but it's still not breaking and holding above. And we know the magnet line that is 108. So, you know, nothing is out the woods on this stuff. But, you know, just to go back again, this is what you look for this week. Through all the events, if you get sucked into the day-to-day moves, end of the week, where are we? Are we at new levels? Are we going to set new ranges? Are we breaking somewhere we haven't been for a while? And in most of the majors and most of the pairs, the answers at the moment is no. And that's why you can't look at the data, look at the FOMC and think, yeah, you know, dollar's going to rally 500 pips or dump 500 pips. Euro's going to do the same, because we haven't done that for months through all that. Ali's, before I hand it over to you, Kay, Ali's asking about dollar CAD, tempted to go long for a long-term trade. Support levels. Well, Gav pointed out pretty well, you know, we've had this 138 area, been a resistance point. That's our close support point at the moment. We've run into trouble 139s, big numbers 140s. If you want to be going a long-term trade here, then you've got to go small if you want to start entering here. So if you want to sit in a trade for a few months, I don't know what your risk is, 1%, 2%, you've got to split your trade up, I think, cut it up into bits, pick your support points. The big support point is obviously one of them, 136.5. You might be able to lean on 137, definitely down to 135s, 134s, that sort of area. So, you know, it's okay saying, yeah, I want to buy it here for long term, but you can't do that with a 50 pip stop. You've got to give yourself some room on that, Ali. And if you're trading long term, well, watch your target, or rather not watch your target. What are you looking for it to do on the upside? You know, you expect maybe the BOC to be the first to cut rates. I'm not so sure, but, you know, that's your strategy. So you're going to be thinking that we're going to be going over 140, maybe up towards these highs. So, yeah, when you longer term trade, you've got to dip in little bits so you can spread your risk. So if you are wrong, you plan that in. So what I tend to do over, you know, something like a longer term trade, I'll say, right, well, I'm going to risk 1%, but I'm going to put a bid on here at 138. If we get down to 136.50, I'll put a bid on there. If we get back down to 135, I'll put a bid on there. And over all that space will be my 1% risk. And then my stop, I don't know, will be 133.5 if that's what I decide to do it. So it may mean you don't get in all your trade. You know, if you think I'm going to buy 138, 136.5, 135s, it might not go that low. You may just get 138, 136.5 or 137. So you may not get all your trade on, but that doesn't matter. It's better to be in something and it working than in all of it and it not working. And then maybe you add on positions as it starts breaking higher. You know, we break 139 and then 139 becomes support. Well, then you think, right, I'm going to add my position there and I'm going to bring my stop up, but I still keep that 1% risk. And when you do that, you take the pressure off because you're not worried about all this pissing around between 138 and 138.60. When you're trading longer term, you can sit back a bit. You know, you're not so much concerned with intraday noise. You know where your risk is, and you let the trader breathe a bit and hopefully it goes your way. So that's what you're doing, Ali. Good luck, and yeah, let us know how you get on, where you start getting into, where your stop is. I always, even if I'm not sure on a longer term trade where I want to put my stop, I'll have a disaster stop in, just in case, something flash crashes. I'll have something in somewhere that if it does blow up, I've got a disaster stop in, and I'm not going to, do my account. I may do a little bit more than my risk, but I'd rather do that, get caught out on 1.5% than not have a stop in and find I'm 5% off. So you got to manage trade, but do that before you start, Ali. Plan your trade before, where you're going to enter, where your risk is going to be, and then do your trades. And don't go chasing. I have a big FOMO issue when I want to go long term. I always start too early. And what I usually do is just put a little tiny slither on just to kill that FOMO, at a high level or something like that. Anyway, Kay, do you want to just grab a few pairs?
Yeah, do you want to have a chat about the BOE while I take the
Oh yeah, we've got the old BOE, haven't we? Yeah, go on
yeah.
then. BOE. What should we do for the BOE?
Okay.
Right.
Let me start by showing the differentials. So we had this blip in sterling differentials after the on what happened yesterday. We had a bit of a shocker when Asia came in as well. When Asia came in as well, late last night. But this is what happened after the FOMC basically. But we are already coming back because European and sterling UK yields are even though the dollar yields are coming off, and that has a direct impact on the dollar side of things. Yield differentials are still not showing the viability of moves, whether it be in sterling or in the euro moves. But again, and I've always said and repeatedly that differentials are not the only thing we need to look at. It's just a guide, okay? But if you look at the European and dollar differentials short end, they're still there. I think we are going to have to look at a little bit at the longer end of stuff, but we don't always have the time to look at everything over here. But if you look at the short end, and that is a bit in line with what the US Treasury then told us about bills and notes and stuff. It's still not supporting a longer term or a bigger, huge reversal in the euro dollar. But again, as I said, this is only a guide. Okay, there's much more going on in a market than what differentials may show us. Otherwise, the market would always just be following those differentials. So yesterday we had a bad day for the dollar. After trying to get back below 105.20 here, we did briefly, but we didn't even come close to the 104.80, 105 the figure zone, and now we are bouncing again. We are back into this 106.35.50 zone, but again the 107. Stretch it even if you want to 107.25, but the 107 is really where we are going to have to monitor what happens to especially the dollar side of the pair, okay? Because still, to me, there's not a lot that warrants a big rise in euro, and I'll show you the euro Kiwi, the euro Aussie, for instance, later. But on the euro dollar side, we can't rule out, especially with what's rating this afternoon, not so much, although we had a little bit of a stir in the market when those continuing claims came out last week. So we are going to have to keep an eye on those. But I think tomorrow it's Friday for a starter, and we've got the NFP and the ISM services coming out. So tomorrow is going to be another big day for the dollar side of things. All right. So in the meantime, we can't rule out that the market is trying to tell us that it's enough in dollars right now. We're going to have to look at this one in dollars. Okay. So Do I have it here? Yeah, I have it. So we had the 480, of course, where the market was trading around. We had those. The 5% is now really key on the top side. We will see as data come in, as the refunding program kicks in again, we will see whether this gets revisited or not. But to me, I think the real panic zone will likely more be around here, and that's somewhere 454, 460. That is your longer term break zone. We had a bit of a move below, and then the springboard to go up to 5% in the 10 years. Yes, we are coming off because that yesterday trilogy really weighed on the US yields and on the dollar. So yes, we have to see what happens around 477, 481. Especially tomorrow, I think. But for the panic to set in the market, I think we are going to have to break this zone here, and then we are going to talk about the lower end of the 4% again. Is it warranted right now? Again, as I said on the beginning of the show, it's not one ISM manufacturing that is going to change the whole picture for the dollar. It's also not a couple of billion of dollars differences in the funding, in the US Treasury funding, that is going to make a big difference. But the balance of what they are doing between bills, notes, and bonds is of some importance. And the Powell giving us a bit of an unhawkish meeting yesterday is making the market think. Okay, so but I would really pay close attention to what happens for stretch it to 450 here, 450, 460 on the US 10s. If that if we get into there and then we start to go up again, then I reckon your dollar is going to get some of it back. We have to talk about the Bank of England, Ryan, okay?
Yeah, sure, mate.
So first of all, where are we at? Okay, and we're going to do it a bit in reverse, if you don't mind. Where are we at? We had a visit under 121 yesterday in the cable, and I was saying in the room it felt a little bit cold under the 121 level in the cable, and that's exactly what happened. Sterling dollar is still remaining a bit on the heavy side globally, barring yen. But if you look at stuff like sterling Aussie, sterling Kiwi, sterling CAD, stuff like that, it's still a bit on the heavy side. If you also look at the euro sterling, it's back well above 87 after a visit below. We are running into the first resistance here around 121.90, 122.05. Above there, we are going to have like resistances every 25, 30 points, but the big zone is still going to be the 123. We had a spike above earlier in October, but I would still say that a close above below this zone is going to tell us whether sterling has more power to go higher, or we are going to cap in there. Of course, there's the dollar side, but this for the cable. Euro sterling is still basically in a move up. This is a bit of a wedge, still in a move up. I'm not a huge fan of the euro, but we have to note that all the lows are still higher in the whole of this move. Okay, so this is still oriented to the top side, regardless what happens over here. Yeah, we haven't traded it very well, but because we wanted to be defensive, but it's still, if you look at it overall, it's still in a move up. Right. What are we going to do today on the Bank of England, Ryan? I'm saying it's could be a bit of a somewhere a non-event, but just the fact that Bailey is part of the Bank of England, he's probably going to keep the sterling under the cushion.
Yeah, I mean, you know, last meeting it was a split decision, 5 voting for unchanged, 4 voting for a hike. This time it's expected to be 6 for unchanged, 3 for a hike. We have got Sarah Breeden, the new Deputy Governor, in, so it's a bit of an outlier there. I think there's probably a greater chance we get a 5-4 than the market might expect, just to keep that message, and it's just only a message that a hike is still on the table. I don't, given what you have to look at is what is the pound, what is the dollar doing going in. The dollar's weaker today, okay? That's going to be the main theme if that continues. That's going to outweigh whatever happens at the Bank of England. For now, right now, as I sit here, I don't see any pound weakness over the BOE lasting. So if you get a dip in cable, I don't see that lasting. I think that might be worth a fade. So that's something to look at cable. If you get a knockdown to those 121 lows, that might be something worth jumping on, because what's happening in the dollar is going to take over later on. For euro sterling, I think if you do get something a bit hawkish, again, is it going to last? The euro's the stronger currency at the moment, so a dip in euro sterling, I might be inclined to have a go again, just nipping a dip in there around that support area, 86, 80, 90.
Yeah, and the thing is as well, I'm not saying you're protected, but for somebody who wants to buy a dip here, you've got support coming in below there, all the way down to, let's say, 86.55-ish, from 86.70-ish. You got like 15 points here, where every 5 points you can find support. So if you hide your stop below there, you know that if it breaks up 86.5, you're probably wrong. Lastingly break sub 86.5, you're probably wrong. But there is indeed a fair chance, looking at how this euro sterling trades, that this could go a bit higher still. And I agree on the cable because of the dollar, and that's why I left a couple of flyers out in overnight to get short sterling Aussie, but of course, I mean, I wasn't done, because it never even bounced the peep overnight. But this one looks a bit fragile to me as well. It really looks as if sterling, okay, and you have to really differentiate what you do when you do a currency. We always said that if you trade a currency, if you want to buy a currency, look what it is the strongest against, or look what the other side of the pair, which currency is trading the weakest for now. And if you do the opposite, if you look to sell a currency, you have to look at which currency is behaving the better against that particular currency right now. And we can safely say that since yesterday, trading cable on the short side is a bet, is more of a bet than trading dollars on the short side, right? So we have to differentiate which currency is the strongest against which other currency. I think
that pound Aussie is similar to cable. If you get a bit of hawkishness from the BOE and that rallies, again, you've got to think, well, maybe the Aussie trend is going to reassert itself, and people are going to hit the rally in that one.
And
it's times like this, you don't have to worry what your thoughts are on the Bank of England. It doesn't matter whether you think they're hawkish or dovish or whatever. Look at what prices are doing in the meantime. In that cases, you go with the strongest trend of the day or week or whatever.
Yeah, this one you could actually, I think if we rally, this is going to be nearly 1%. If you rally from here up to high 190s, it's probably already going to be enough. But of course, I think the big resistance lies somewhere up here. But if Bank of England is a bit weak, this looks like this break can take us down into the 86s, really. But okay, that for this pair. But on the Bank of England itself, the problem is that Bank of England will send a message to the market which is purely based on inflation if they want to stay more hawkish, and because they cannot really base it on extraordinary good data. And again, I compare to what the US is doing. In the UK, we are expecting like 0.5% growth or so, quarter per quarter, the 1% max. PMIs we have seen were average at best. There's more articles out that the construction side of things is not going particularly well either. So I'm not inclined to buy too much sterling on the back of that. So the only one really where the Bank of England is going to try and keep the hawkish message is really on the inflation front. But very interesting what you said, because if Breeden, for instance, sides with the more hawkish side of the council, we could get this 5-4 vote, and then the market will probably jump a little in the sterling, right?
Yeah, exactly. And then you got to look at the other side and see if it goes too far. But anyway, we've hopefully given you some good two-way thoughts for the Bank of England, especially. There's reasons to go long, there's reasons to go short if it happens. So yes, I think unless you got something else to show, Kay, we'll call that a day.
No, not really. I mean, just a bit of a cloud action on the 4 hour in the dollar yen, where we stopped right here. But I could show a lot of stuff. But just one thing we have in the Q&A, we have anonymous attendee. It would be nice if we see your name so we can name you. As a swing trader with a day job who wants to spend a little time looking at charts and looking for currencies to target for range trading, do you have any currency pair suggestions that stick to ranges generally? If you have a day job, first of all, it doesn't make things easier. The thing though, if you want to be a swing trader, so de facto you're going to be a little longer term, right? So that cancels a bit of the noise of daily moves. If you also coming back to your day job thing, that means that you don't have like hours and hours and hours of time to look at what's happening and look at charts. So the first thing that I'm going to suggest you is to stick to just very few currency pairs. So you can trade majors, for instance. You can trade euro, dollar, you can trade sterling, you can trade yen, Swiss, Aussie, Kiwi, depending on where you are. If, for instance, you are in a zone like Australia, you may be looking at stuff like Aussie, Kiwi. And if you are in Europe, I would stick to the traditionals, the euro dollar cable. But even though you don't have too much time to look at stuff, I would still try. You don't always look at only at charts, okay? Ryan and I look a lot on the fundamentals. Do take time besides your chart study to see what's really going on with the economy of a particular currency. You have to be up to speed with the data. You have to be up to speed with what central bankers are saying, because they drive the market. The best example was, again, Powell last night. The market really started to move once he was done. You have to stay up to speed with what's going on, not only look at beautiful pictures, okay? Because that's then you're going to miss a part of the market. So that's the thing. And because you have to do that, I think you need to be aware of what's going on the fundamental side, though that gives you a little less time to really study charts in depth. So then you have to really stick to few currency pairs and prioritize the currency pairs in the time zone where you are.
Yeah, I'd second that. I think, as mentioned, euro dollar 105, 107. It's the most liquid FX pair. And it does tend to range a bit. Otherwise, look at the crosses. Euro sterling, it moves at snail's pace, but it means you're not going to be coming in every day looking at it twice and it's 50, 100 pips away from where it was the day before. You've got time to pick your levels and trade between the ranges. Another crosses, slower crosses like Aussie, Kiwi, exactly that. Right, well, we need to call that a session, as we've been banging on for quite some time now. So have a great rest of your day. Be careful over the BOE in 40 minutes for you Yanks who might be joining us. It's not too far away. It's right as we start F.A.C.E. So join us on there. We'll be giving our live reaction to that as well. Have a great rest of your day, and we will see you for the jobs report tomorrow. Have a good one. Cheers, Kay.
Cheers, guys.